Hi, and welcome to the Basics of Personal Finance, How to Budget Part 2. Today we're going to be taking a look at some advanced budgeting skills, but before we get into that, let's talk about why we're doing this. We're doing this because we want you to be wealthy. Wealth being defined as having time and money. What good is money if you don't have the time to spend it? Because we believe that true financial independence happens when passive income is greater than your expenses. Why do people not achieve this? Simply that the greatest barrier to achieving this is a lack of financial education. So this is why we're doing this. So we're going to assume that you've already completed part 1. This is part 2. We're going to be covering what to do when your budget doesn't match up. Emergency cash, how much do you need? Emergency cash, how do you get it? Occasional expenses, how to budget for them, and using your bank. Okay? First of all, what do you do when your budget doesn't match up? When your expenses are greater than your income? Well, first of all, welcome to the club. This club is called Everyone. No one's budget matches up the first time. This is perfectly normal. So what you need to do is take a look at the budget and start altering the various expenses to bring them down. And the ones you want to pay particular attention to are the rent or mortgage and your car expenses. Simply because most people end up spending too much in each one of those two categories, and those are also your two biggest expenses. Take a look at both of those very carefully, bring it back into balance. If you haven't done that yet, do it now. Next up, emergency funds. Your very first savings goal from your personal budget should be emergency funds. Why? Simply this is because you could lose your job, you could be injured. There's a whole variety of unexpected things that could happen in your life that you will need money for. You need to set aside at least 3 months worth of your living expenses, including that miscellaneous calculation we talked about before. How does that work? Well, for example, if your living expenses are $3,000 a month, then that means you need $9,000 in the bank. And you need to put that in a separate account, preferably one that takes 1 to 2 days to withdraw, to stop you from having the temptation of taking an emergency trip to Cabo San Lucas. These are for real emergencies, losing your job, being injured, not emergency retail therapy. Okay? Why 3 months? Simply this. If you lose your job, it takes an average of 10 weeks to get it back. Where do we get this? According to the Bureau of Labor Statistics, as of December 31st, 2011. Feel free to take a look at their website and get some more updated data if you like. Keep in mind as well, you also don't get paid the very first day you get a new job. So if it's going to be another 2 weeks, 10 weeks worth of being out of a job, plus another 2 weeks, that's 12 weeks, that's 3 months. Keeping in mind, that's a minimum. In actuality, there's 4.3 weeks per month that we're doing this for. So you think about it, 52 weeks a year, 12 months, and every single year, 52 divided by 12 is 4.3. It could be even longer. So make sure you've got a minimum of 3 months aside. And the next question we get is how to build this. Where do you get these funds? Because $9,000, if you're earning $3,000, or if your expenses are $3,000 a month, is a lot of money. First, you want to make sure that you're setting aside some out of your regular savings. Every single paycheck saved for this. How much should you save? Roughly 1 month out of every year. So for example, if your living expenses are $3,000 a month, $3,000 divided by 12 months is $250 a month. You get paid twice a month, 2 paychecks. $250 divided by 2 is $125 a paycheck. Add that into your budget. Start setting that aside now. The next and probably the best tip we've got when it comes to emergency funds is to use each year's tax refund, if you get one, towards your emergency funds. So if you're saving 1 month's worth of living expenses every single year, and you should be able to achieve your 3 months within 3 years. We combined both of these two strategies together. We tested them, and we achieved the 3-month goal in a little over a year. Absolutely possible to do. What about occasional expenses? What about how do you budget for them? Things like the dentist or roof repairs. They're typically expensive. They only happen once in a while. How do you build that into a budget? Well, really simple. First, find out the total cost. If a dentist costs $250 per visit, take a look at that. Keeping in mind that we're using the dentist as a specific example because even if you have health insurance that will reimburse you for this, you typically need to pay out ahead of time and they pay you after. So you need to make sure you have that money ahead of time so you're not putting it on your credit card and incurring interest rate charges if they're late or don't pay you at all. So even if you have health insurance, make sure you're budgeting for this type of stuff. Secondly, find out how often it happens. You go to the dentist twice a year, that's $250, that's $500 a year. Third, turn that into a per paycheck figure. If you get paid twice per month, then it's 2 paychecks times 24 months equals 24 pay periods a year. If that's the case, check with your employer, check with wherever you get paid to see how many pay periods a year you get. And then simply divide one by the other. $500 in total expenses every year divided by 24 pay periods every year is $20.83 per paycheck. Now go ahead and put that into your regular budget. And do that for all of the different occasional expenses. This could be house repairs. If you drive a car, it will break down. Are you budgeting for that? House repairs, same thing. Dentist visits, car replacement costs. Even if you lease your car, you'll probably need to put more money in when you renew the lease. Are you budgeting for that? And of course, your children's education. If you have kids, start budgeting for that as well. There's also some things today with your bank that will help you with personal finance that just wasn't available years ago. It reduces our need for organization. It reduces our need for effort because we can set things up automatically. So firstly, set aside separate bank accounts for these savings items. Dental bills, furniture, clothing, holidays, emergency funds. We actually ended up setting aside one account for dentist and furniture, one account for clothes and holidays, one account for emergency funds, because we had a limit in terms of how many accounts we could open for free. And once you've got that set up, you need to make sure that you either use the internet or call your bank and set up regular withdrawals from your main account into these separate accounts. So it happens every single paycheck, so you don't have to remember, and you're not left just transferring out whatever money's left at the end of the month. That's the wrong way to do it. You need to pay yourself first. So the regular withdrawals, the common knowledge seems to be that you won't notice them. Well, actually, when we tried it, we actually did notice it. What we were more shocked by is how fast the money built up, and we hope that'll be your experience as well. Taking a look next, let's summarize what we've looked at. Budgets never match up the first time. Don't worry about it. Just keep adjusting your expenses and work it back. You've joined a club. The club is called Everyone. Save 3 months worth of living expenses. Start this by saving 1 month's expenses every single year and add that to your tax refunds into your emergency reserves every single year. And lastly, you want to budget for occasional expenses by breaking them down into per paycheck payments. Use your bank, set separate accounts and regular withdrawals on every paycheck towards each of these items. Because here's the reason why. The reason why is simply out of a quote from a gentleman in a sales organization that we had talked to, whose job was to increase their income. So people would go from earning $10,000 or $20,000 a year to $100,000 or $200,000 a year. And what he said is that people's financial circumstances were just magnified the more money they made. So if they earned $20,000 a year and they were $10,000 in debt, when they started making $200,000 a year, they found themselves $100,000 in debt, because you haven't changed a lot of the basic ways that you budget and spend your money. So let me ask you this. If once you've completed your budget, would you like to add a couple of zeros onto that? Would you be happy with that result, or would that depress you? If that's going to depress you, if that's not going to make you happy, then you need to change your budget to make sure you're going to get where you need to go. Who are we and why are we doing this? Simply because we want financial independence too, and the biggest barrier to that is financial education. But there seems to be a real lack of data on how people actually achieve this. What do we want you to do? Simply this. There's a link attached to this video. It's a survey. We want you to fill in the survey because we want to find out. We want to build a large database and follow people from point A to point B as they go towards their financial independence to find out what works and what doesn't, and we'll share that. That's what we're looking for. Next up, we're going to talk about how to make money. Coming from the perspective of we're not financial experts, and we'll add a bunch of legalese in there to make sure no one can sue us. This is simply more of a book review of some things that we've read about and we've tried and they've worked. So budgeting is defense. We're going to take a look at offense, how to make money. We're going to take a look at specifically dividend investing, how you can make a relatively safe 5% in return on your investment every single year, and sometimes even more. If you want a preview, read Stop Working, Here's How You Can by Derek Foster. So we'll see you next time.